More bank earnings coming in today with mixed results. We heard from Bank of America and Morgan Stanley. Our next guest says there are still headwinds the industry has to wade through, and he favors bigger, more business-diverse banks. Here with us now to break down the latest bank earnings is David Ellison, portfolio manager of the Hennessy large and small cap financial funds. David, it is great to have you on the show. So maybe let's just dive right in, David, to some of these names. Morgan Stanley, they reported investors seem pleased. Walk us through the results, David. What'd you make of them?
Well, the investment banking has been good across the industry, and they had a good investment banking, sales and trading quarter. Asset management continues to do reasonably well. Obviously, the market's been making new highs, and so the flows and the assets should follow that at Morgan Stanley. So I think it's also one that's less sensitive to what's happening with traditional banking, yield curve, credit. Absolute level of rates don't impact them as much. So I think it becomes something to kind of hang out in while you're waiting for the resolution on some of these other headwinds that aren't impacting Morgan Stanley.
Yeah, I mean, we saw that really reflected in the other big banks that do have both sides of that business, right? Goldman doing better, more in the Morgan Stanley category. Then you have
Right.
Bank of America reporting today, the sort of trading and asset management side of the business doing well, like it did at many of the banks, but higher credit card charge-offs, which reflects the more consumer challenges that are out there right now. How long are we in for that at the banks, that sort of delicate balancing act?
Yeah, well, I think the operative word they're using now is credit is normalizing, which is code for non-performers are rising. And they're rising pretty much across the board, not very fast, at least for the ones that have already reported. And so I think that will continue just because that's what happens when these cycles start, it seems like. And obviously you got to watch it. Everybody's worried about commercial real estate, office, et cetera. Everybody knows about that, but it's still going to be an issue. So I think they've got to wade through that. I don't worry about that much because everybody knows about credit. Everybody's dealt with credit for a long time. I've been doing this for 40 years. We've had credit cycles. I think the boogeyman or the real new issue is what's going to happen to the deposit side. Because since sort of the Silicon Valley, First Republic issues of a year or so ago, the deposit side has really been exposed as a risk factor for the industry that we've never had. So you see most of these large banks losing non-interest-bearing deposits to the market. I'm not sure where they're going or where they're ending up, but that really is the golden goose of this industry, or these low-cost deposits that they can fund reasonably low-risk loans with and make a decent return over time, lever it up, and you do okay. And that covers a lot of sins with some of the other more risky stuff they do. But if they continue to lose that, that's going to be a long-term problem for them in terms of margins and overall profitability. So if I worry about anything now going forward, it's going to be what's going to happen to those deposits and what are those deposits going to cost them long-term.
Can I ask you, David, kind of as you look across your coverage universe, is there one bank you're more bullish on than others? Do you have a top pick?
Well, I like J.P. Morgan. I think that's one's easy to own. It's the best in class in all of its, it sort of owns the waterfront property and all of the areas where it does business. I like Citicorp because it's the cheaper one. Again, Citicorp and J.P. Morgan roughly have the same book value. One's trading at 60 and one's trading at 180. So clearly there's a valuation gap there. On a price to book basis. And if Citi can do anything right or anything better the next couple of years, the stock will close that gap. And so I think that's the opportunity there. So you've got the good and the bad, or the good and the one that's been bad that can get better. So those are the two that I think are the most interesting. Everybody else is kind of in between. Again, all these companies are kind of swimming in the same pool. They've got roughly the same assets. They've got roughly the same cost of funds. And it's all about management and managing that balance sheet. So, it's a homogenous industry more so than it used to be, which is why you see them all trade together most of the time.
David, we talk with a lot of investors about when the Fed is going to cut interest rates, right? And I think some have made the argument that if you're talking on a macro level, a stock-wide level, the timing doesn't necessarily matter as much. It probably matters to the banks, right? And so as you think about when the Fed is going to begin to cut, how much of a difference is that going to make in the earnings of these banks, especially when we're not getting increases in net interest income forecasts?
Yeah, well, again, I think we're not getting increases in net interest income as much as we'd like because we're losing those core deposits. And that's really hurting them, although it doesn't show up as much as maybe it will over time. But I do think, again, this is an industry that is impacted by rates. Microsoft is not, NVIDIA is not, Google's not, but the banks are. And the yield curve's been in a negative position for a long time. I think it's the second longest in history, at least if you go back as far as maybe you want to go. But so the industry has been struggling with that, and the Fed controls that. And I think that's, unfortunately, that's part of the problem with the industry is that they're exposed and sensitive to macro issues that are controlled by government entities that may or may not care about how they're doing. And I think you saw that in the last 18 months with Silicon Valley and First Republic and so on and so forth. When they fail, the market doesn't care and the Feds don't care. They just merge them into other banks and move on. So we're in a different environment now from a rate point of view, from a regulatory point of view. If there are more failures, the banks don't care. And if you go back to 2008, they cared because the big banks were in trouble. And so they had the ear of the regulators and the guys at the top of the food chain. The little guys do not. And so nobody cares about them. And if they continue to fail, it's actually good for somebody like JP Morgan, who has benefited mightily from the First Republic deal. And so I think the industry is bifurcating. The big guys matter, the little guys don't, and you should invest accordingly.
Yeah, quite a different picture than in 2008, most definitely. David, thank you so much. Great to see you.